5:30 now. Thank you so much for your time. First of all, Upasana, help us with your understanding on the union budget, because what we have seen is that the government is right there on the consolidation path. Now, to rev up the business cycle, the responsibility falls squarely on the RBI. So, give us a sense that how was the union budget announcement has been for you, and going ahead from RBI, what kind of measures do you expect?
Hi, thank you for having me. From a union budget perspective, I think the budget does a good job of balancing different needs. Firstly, it has stayed the course on fiscal consolidation, consolidating the fisc by about 40 basis points going into fiscal 26. Managing to give a boost to consumption through these tax cuts, which benefit all taxpayers. I think there was some expectation that there will be some tweaking of the tax rates, but I think what we got is a little on the positive side. It is higher than anticipated. And lastly, the capex momentum is still maintained. Yes, the nature of capex spending has probably changed a bit, and they're more trying to use levers such as transfers through to states to rev up the capex spendings. But I think overall the theme that capex allocation remains higher than revenue spending in terms of growth rate has still been maintained. So I think it does a good job of balancing, boosting consumption, maintaining fiscal consolidation, and also maintaining capex expenditure. So I think growth is supported through this budget. We think that we will see probably more broad-based cyclical recovery through these measures announced in the budget. And from a monetary policy perspective as well, I think from the policy review that will be there tomorrow, we do expect the start of the easing cycle. We've already seen that RBI is taking measures to address the liquidity issues that have cropped up since mid-December. And we think probably more on those lines will also come through, especially as, up to March end, liquidity does remain a bit tight. So we think that both fiscal and monetary policy are sort of pivoting to support growth, and that should help in the cyclical recovery.
Upasana, Shell also joining in the conversation. I want to play a bit of a devil's advocate here, because given the fact that the union budget, you're seeing a push towards the consumption and the capex, we're expecting the consumer discretionary end of the consumption pact to do well. Industrials also look pretty well placed, given the fact that, yeah, you are seeing some sort of a capex growth as well. But I wanted to understand, is there a risk that this tighter fiscal deficit path could actually eventually squeeze the liquidity, impact the market sentiment?
So fiscal deficit is consolidating, and that is in line with the medium-term plan. Rather, if we look at the drag or the consolidation from the fisc, it's 40 basis points for fiscal 26, meaningfully lower than what we saw in fiscal 25. So I think on that side, the fiscal consolidation path is par for the course. It doesn't create any major concerns from a liquidity or a market standpoint. From a borrowing perspective as well, which impacts, market liquidity on the debt side, that the borrowing numbers gross are marginally higher versus last year due to higher redemptions. Net numbers are largely in line. So I don't think this creates any major concerns on liquidity or, if the consolidation is going to squeeze on the growth side as well, because the drag is probably is reducing versus what we lived through in fiscal 25.
Also give us a sense that how much has the liquidity improved in the banking system after the recent RBI measures? Because just tomorrow, yes, indeed, you did share your expectations from the policy meet, and the commentary will also be what we'll be looking out for. But in terms of the liquidity positioning for the banking sector, has anything improved incrementally or substantially?
See, the measures that have been taken up do address a part of the liquidity deficit. Total amount that is supposed to be added through the measures that were taken up last month was about 1.5 trillion rupees, but the deficit at that time was tracking at about, much higher than that, about 2.5 to 2.7 trillion. So it does address a part of that liquidity deficit issues, but probably as we go into further into, especially March end, with you'll have advanced tax outflows, yes, temporary issues, but they do squeeze liquidity. So in that that context, we do think that probably some more in line of those previous measures, like either OMOs or FX swaps, combination of those or longer term VRRs would still be needed to just ensure that financial conditions don't tighten materially. So with those liquidity measures, yes, there has been some improvement in terms of the overnight call rates, but probably you need to do a little bit more so that you don't you avoid the preemptive tightness in financial conditions if there were no measures taken up, especially given the seasonal factors are stacked against liquidity in the next few weeks.
You know, I was reading your report, Upasana. Interestingly, you did mention the fact that about a stance on the Indian equities, where you're saying you remain constructive on the Indian equities. But what actually struck over there is that you have bias towards the SMID over the large caps. So, given the current valuation gap, do you think now is the time that you can look at these counters in the small and the mid cap space? And especially when you talk about that, is it more tilted toward the consumption side or the capex theme?
So that's our view of our strategist, Rhythm Desai. Yes, he's biased towards, as you mentioned, these sectors. We do think that given where we are, and I'm just relaying his views over here. There is probably more scope in terms of private sector financial, large private sector financials, and also consumer discretionary themes, especially with the budget that has come through. On the industrial side, we do think that overall longer term, the industrial theme, even from a macro or an econ perspective, does sustain. Probably there would be some rejig in terms of the subsector themes in the industrial side, given how the budget allocations have moved, as we discussed earlier. Budget allocations or the ministry-wise spending has changed. Roads, rails are largely flat. There's been higher allocation across some other other ministries such as housing, defense, etc. So there would be probably need to rethink at the sub-segment level on the industrial space.
All right, Upasana, with this, we'll let you go on that and really appreciate you taking the time out and speaking with us.